try to get to that. Expert on it as well as Patrick Fruzzetti. John Tucker, thank you. Managing Director, Fruzzetti, Managing Director, Partner, Rose Advisors. I mean, this is the innovation of America, which is the underpinning of our confidence to invest.
That's very much correct. Thanks for having me. I think investors today, when they're looking at the landscape, they're saying, well, where can I invest? Look at this run in the market. Look at where interest rates are moving. When's the next shoe going to drop? And I think when they look at that type of news, they look at innovation, they say, hey, are we investing in the right places? Are we allocated in the right way? And, how do we think about risk going forward? That's where my clients are thinking these days.
Let's stick with our trend this morning, where we're asking guests their input on Druckenmiller's op-ed in the Wall Street Journal today, sort of, chiding his mentee about intervening in the bond market. Your thoughts when you read that?
Well, there were a couple of great quotes. I'll say, that where he talks about, and it captures it a lot, where he says, for every basis point in artificial yield suppression is a subsidy to procrastination.
Okay.
And just this point of that,
kicking the can down the road.
And really, if the market wants to set the 30-year at 5.5%, that's the appropriate level, and it's not a crisis. There's been no failed auction. It's not a crisis. It's an invoice.
Is it a crisis to your clients that have enjoyed price yield up, price down? I mean, they've seen a price decline, right?
It's not a crisis. There has been a price decline, but actually after bond performance in both 24 and 25, so obviously you've given back some on market price this year, but no, it's not a crisis. I think most of clients, especially in the high net worth space, they're looking at coupons, they're looking at income. Right. They're not necessarily focused on market price fluctuation, maybe as say that the bond traders may be looking at.
And the income, the coupon as you call it, looking pretty good. The 10 years at 4.64, the 30 year, if you're willing to go out that long, 5.17. What does all of this do? Because these things don't live in silos. What does it mean for equities and for the longevity and sustainability of the rally there?
Well, look, we had over 10 years of artificially low interest rates, and so it's clearly changed the game. But what it does for equities, of course, if you have sustained pressure on the upside with yields, it ultimately will put pressure on the equity market if there's a hiccup with earnings, say. If there's a hiccup somewhere, in the economy with growth, it could have an impact. But we haven't seen that yet this year. We've seen periods of it, right? Again, a lot of it has been just, exogenous effects, news, oil prices, et cetera. But I think the rally has been consistent. And I think we'll carry the earnings narrative going into the end of the year. But again, we're always susceptible to these interest rate shocks, and that's what they think they're managing here.
Yeah, and speaking of the earnings narrative, right? Tomorrow's going to be a big one. Yeah. NVIDIA. Yeah. What are your expectations for NVIDIA tomorrow? Is there anything they can say that can sort of turn this AI trade on its head?
The answer is yes, they could. I don't think that's the expectation.
Okay.
Though. I saw a stat this morning. I think NVIDIA is around a third of total tech earnings now.
That's
right.
I mean,
it's just so they can move it in both directions. Mm-hmm. And I think it's going to be all about expectations. What's their guidance look like? What does, and what do they say on that call around demand and their expectations? That's going to drive it going forward. So that could turn things around, but we'll see.
How do you link in the Fed Derby, all the other distractions of Bloomberg Surveillance, into that arch thing? Why don't we do nothing?
Why don't we do nothing?
That's a thought.
Yeah. Well, when you're talking to a long-only investor, so doing nothing sometimes is the best decision. So I believe in that. But there was someone else. I read a research piece earlier last week around, I think it was from GAFCAL, and they said something along the lines of, when there's trade agreements written in pencil, maybe you shouldn't write your portfolio expectations in ink. And I think there's something to that.
Very nice. Okay. Patrick, thank you so much. Patrick Fruzzetti with us, with Rose Advisors this morning.